Before we get into the data, I need to ask you something real. How are you holding up right now? Because if you have been watching these markets, reading the headlines, feeling that knot in your stomach every time you open your portfolio, that feeling is valid. This is not a normal market cycle. The signals coming in right now are the kind that show up maybe once in a generation. And most people are going to miss it entirely, not because the data is hidden, but because nobody is translating it honestly. That is exactly what we are going to do today. So drop a comment below and tell me where your head is at right now, because this community only works if we are honest with each other. Now let me give you the headline that almost nobody in mainstream finance is talking about with any seriousness. Gold is on the verge of completing 10 consecutive green monthly candles. And if you understand what that actually means structurally, you will not sleep the same tonight. 10 months in a row, green closes, through rate uncertainty, through dollar bounces, through geopolitical whiplash, through everything the market threw at it. This is not a streak born from retail enthusiasm or social media hype. This is institutional behavior, sovereign behavior, central bank behavior, expressing itself 1 month at a time in the most honest language markets speak, which is price. The last time anything close to this happened in gold, the decade that followed rewrote the financial playbook for an entire generation of investors. And here is what makes this moment different from every other bullish gold narrative you have heard before. The speculative crowd, the momentum chasers, the managed money that typically amplifies these moves, they are barely positioned yet. Let me put some numbers around that, because this is where the story gets serious. Managed money net long positions in gold futures, the speculative funds that pile in when momentum is obvious and undeniable, are sitting well below the levels you would typically associate with a market that has been trending up for 10 straight months. These are the participants who show up late, loud, and with enormous capital, and they have not fully arrived yet. When they do arrive, and they will because momentum is the only religion speculative funds practice, the move that has already happened will look like the quiet before the storm. This is the setup that informed minority investors recognize immediately. The retail crowd sees a rally and thinks they missed it. The informed minority sees low speculative positioning in a structurally driven bull market and understands the real move has not even started. Now let me connect the macro architecture behind this streak, because the monthly green candles do not exist in a vacuum. The US dollar's share of global foreign exchange reserves has dropped to its lowest level in over 3 decades, sitting now below 57%, down from 72% at its peak not very long ago. This is not a rounding error or a data anomaly. Central banks around the world are making a deliberate, documented, multi-year decision to reduce their exposure to dollar-denominated assets, and they are replacing that exposure with physical gold. These institutions do not move quickly, they do not move emotionally, and they do not reverse course because of a single CPI print or a Fed press conference. When central banks move, they move for years, and the flow data confirms they have been doing exactly that quarter after quarter, at volumes that historically correlate with sustained price appreciation in gold. Here is the number that should anchor everything else you hear today. Central bank and institutional demand for gold has been averaging approximately 600 tons per quarter for the last several quarters running. The historical threshold that correlates with roughly 3% quarterly price appreciation is significantly lower than that number. What that means in plain language is that the demand running through this market right now is not just bullish, it is above the trigger point by a margin wide enough to be statistically meaningful. This is not a close call or a marginal setup. This is documented demand that exceeds the historical driver of price appreciation, sustained over multiple quarters, with no reversal signal visible in any of the forward flow data. And then there is the supply side of this equation, which almost nobody is discussing honestly. Gold is not easy to find in meaningful new quantities, and the exploration and development pipeline that would need to be in place to meet surging demand at these price levels takes years, sometimes decades, to translate into actual production. The mines that could theoretically respond to $3,000 gold are not operating yet. What exists is a supply structure built for a different demand environment, now being asked to meet sovereign-level buying that is running above historical norms. The physics of this do not bend for any narrative, bullish or bearish. When demand runs structurally above supply and the gap is not closable in the near term, the price mechanism does the only thing it can do, and it does it for longer than most participants expect. Now, I want to give you the layer that most people watching this market are still not connecting, because this is where the story gets genuinely important. There is a credit market sitting underneath the surface of the financial system right now that carries a risk profile most retail investors have never heard explained clearly. Private credit, the non-bank lending market that has expanded dramatically over the last decade, now represents trillions of dollars of capital deployed into illiquid, long-duration assets. Some of the largest players in this space have been funding the infrastructure build-out of the artificial intelligence wave, data centers, computing capacity, the physical backbone of everything, The technology sector has been promising investors for the last 2 years. The debt loads carried by companies in this space are significant. The cash return timelines are long. When a major private credit fund restricts investor withdrawals, which has happened recently in ways that have not received the mainstream attention they deserve, the question that follows is always the same. Is this an isolated liquidity management decision, or is it the first visible expression of a stress that runs deeper through the system? The honest answer is that nobody knows yet, and that uncertainty is itself a signal. Markets do not price known risks at crisis-level premiums. They price uncertainty. And gold's volatility, recently hitting levels not seen since the global financial crisis, is the market putting a number on tail risks that have not fully materialized, but are visible in the underlying data. Let me bring in the housing market for a moment, because this is another data point that belongs in the same conversation. U.S. pending home sales just printed near historical lows, with year-over-year declines of a magnitude that, in any previous cycle, would have triggered immediate policy response and significant mainstream media attention. The housing market is not slowing, it is frozen. Affordability has collapsed to levels where the transaction volume simply cannot sustain itself, and the credit conditions that would normally restart that transaction volume are not easing at a pace that changes the near-term math. A frozen housing market is not just a real estate story, it is a credit story, a consumer sentiment story, and a systemic risk story, all expressed in a single data set. When you overlay that picture with private credit stress signals, dollar reserve share at 32-year lows, and gold running 10 consecutive green monthly candles, you are not looking at separate stories anymore. You are looking at different windows into the same building. Robert Shiller documented extensively in his research how markets begin repricing risk assets before the broader public recognizes the shift is underway. The repricing in gold is not a prediction. It is observable in the price structure right now, in real time, for anyone willing to look at the data honestly. Now let me talk about something that the comments from this community have made clear is needed, and that is the honest case for why this could be wrong. Gold at these levels, running this kind of volatility, in a market where speculative positioning is still building, is a market where sharp pullbacks can happen without any change in the underlying fundamental picture whatsoever. A 10-month green streak does not mean month 11 is guaranteed green. It means the structural forces producing that streak are still intact. The distinction matters enormously because the participants who get shaken out of correct positions are almost never shaken out by a reversal in the fundamental thesis. They are shaken out by a price move that their conviction was not deep enough to absorb. Jim Rogers wrote about this dynamic in detail when describing commodity bull markets, noting that the corrections that happen inside multi-year structural moves are violent enough to feel like the thesis is broken when it is not. The structure holds. The conviction of the underprepared does not. This is why the combination of fundamental understanding and technical awareness is not optional for anyone operating with real money in real markets. Fundamentals tell you what the destination is. Technicals tell you the road conditions between here and there. And the technical picture in gold right now is saying something specific that deserves direct attention. Price action has memory. There are structural levels in gold's chart that have acted as both support and resistance across multiple time frames, and the behavior at those levels is not random. It reflects the accumulated positioning of participants large enough to move the market, and those participants do not abandon their levels without a structural reason to do so. The bullish structure that has been forming in gold over the last several months, the higher lows, the consolidation at levels that previously served as resistance, the breakout behavior followed by retests that held. This is not a retail-driven pattern. This is institutional accumulation expressing itself in the language of price structure. When you see that kind of structure building in a market where central banks are buying at record pace, where speculative positioning is still near lows, and where the macro backdrop is actively reducing the credibility of dollar-denominated alternatives, the alignment between fundamentals and technicals creates a level of conviction that is genuinely difficult to argue against. That level of clarity is what separates the investors who hold through the violent corrections Jim Rogers described from the ones who sell the low and watch the recovery from the sidelines. Let me now tell you what the informed minority is watching for the next signal layer. Silver miners have been diverging from spot silver in a way that intermarket analysts recognize immediately as a forward-looking signal. When equity markets in the mining sector begin pricing in higher future metal values. Before spot has caught up, it reflects the forward earnings models of institutional mining analysts, who are building in price assumptions above current spot levels. That divergence, miners running while spot lags, is not a coincidence, and it is not noise. It is one asset class telling you what another is about to do, and it is doing so through the most rigorous pricing mechanism available, which is the discounted cash flow models of institutional capital. Now I want to bring this back to gold specifically and the 10-month streak, because I think the significance of this record is still being underestimated, even by people paying close attention. 10 consecutive green monthly closes in gold means that 10 times in a row, across 10 different macro environments, 10 different news cycles, 10 different moments where the bears had a credible case for a monthly reversal, the buyers were more powerful than the sellers when the month closed. That is not a technical detail. That is a declaration about who is in control of this market at the structural level. The buyers producing that record are not retail investors reacting to headlines. They are sovereign wealth funds executing multi-year allocation shifts. They are central banks diversifying away from an asset, the US dollar, whose reserve share is at a 32-year low. They are institutional investors, whose models are telling them that the risk-adjusted return profile of gold at these levels, against the backdrop of the credit and housing data we discussed, justifies the position. These participants do not reverse course because of a bad jobs print or a hawkish Fed comment. They reverse course when the structural thesis changes, and the structural thesis right now is getting stronger, not weaker, with each passing data release. Here's what I want you to sit with after this video. The mainstream financial industry, the same system that manages most people's retirement savings, has systematically underweighted gold for decades. This is not because their analysts do not understand the asset. It is because their revenue model is built around products that compete with gold for allocation. When institutional flows finally accelerate into this space, and the data suggests that process is already underway, the repricing will not happen slowly or politely. It will happen in the kind of compressed time frame that leaves the unprepared watching, from the outside, wondering how they missed something that was, in retrospect, completely visible in the data. The physical shortage signals emerging from major consuming markets are not analyst forecasts. They are current operational realities, expressed through this most direct signal available, which is a seller choosing to refund a contract rather than source the metal. When the world's largest gold-consuming markets cannot source physical inventory at current prices, the price mechanism has only one direction to resolve that imbalance: